We often get questions from 401k participants about whether they should be contributing with pre-tax contributions or with Roth contributions to their 401k. Well, the answer to that depends on a few different factors. Welcome to this month's ASAP Finance. First, let's talk about the difference between the two. Pre-tax deferrals are traditional deferrals that you contribute before taxes are removed. Pre-tax deferrals lower your taxable income for the current year, but they are taxed at the time of distribution. Roth deferrals are the opposite. They are contributed after taxes have been removed. These increase your taxable income for the current year, but they are tax-free at distribution. Not all 401k plans permit Roth deferrals, but if your plan does, making an informed decision about what's best for you could be well worth your time. It's worth noting that if you do make Roth contributions and you have an employer match, that employer match will be pre-tax per the current IRS rules. There isn't one determining factor that will make using a traditional 401k better than a Roth or vice versa. As with everything in financial planning, it's important to weigh multiple inputs simultaneously. When deciding the best approach for your tax and financial situation, here are a few things to consider. Here's when it may make sense to use a Roth 401k. You're in a lower marginal income tax bracket now than you expect to be in retirement. And let's take a quick look at the income brackets. Some tax experts say that if you're in the 24% or under tax bracket, and you're in a career path where pay raises could quickly push you to higher tax brackets, contributing to a Roth 401k makes sense. Again, this is also assuming you'll be in a higher tax bracket during retirement as well. Here are the other examples of when a Roth 401k may make sense. If Roth contributions won't reduce the amount you're saving for retirement, maxing out Roth 401k contributions reduces your take-home pay more compared to pre-tax deferrals. Your retirement savings and retirement income, such as Social Security and pension, are currently heavily weighted towards tax-deferred assets. Adding the Roth contributions to your taxable income won't cause any adverse tax implications. Here's when it may make sense to use a traditional 401k. You're currently in some of the highest marginal tax brackets, and it's unlikely you'll have the same level of taxable income in retirement. Excluding pre-tax contributions from your taxable income is an important part of your tax planning strategy. If you're a high earner and already have sizable tax diversification of your assets, perhaps from a Roth IRA, old Roth 401k, or a brokerage account. Here's a helpful chart that illustrates evaluating a Roth at different life stages. This chart shows a typical wage curve and the general rule of thumb about what type of contribution may be most appropriate based on current income and the anticipated bracket in retirement. An additional consideration is to maintain a healthy mix of taxable, tax-free, like Roth, and tax-deferred accounts to provide greater flexibility and control when managing income taxes over time. Regardless of whether you decide to go with a Roth or a traditional 401k, one primary focus should be on your overall savings rate. Especially for high-income individuals, maxing out retirement contributions alone may not be enough to fund your retirement. As always, if you have any questions about your retirement plan, please contact us anytime.